Now, classifications are used in statements, and these organize the information. So, organizing items into different categories with comparable items. So, items that are similar in some way and can be compared. So, classifications are going to differ according to the specifics of a business. So, factors like size and the activities of the business and the ownership structure are going to impact that. So, for example, if you have a really huge organization, it's likely going to have more sort of elements, more things that need to be subdivided into other different categories, whereas a small sole trader business would be a lot more simple in its operations and wouldn't need as many different classifications. And activities as well, as we'll see, depending on whether it's a trading business or a service business, that's also going to impact the headings that are used. So let's zoom in now on the statement of profit or loss. So this statement classifies both revenues and expenses. And you can see a standard classification is here on the screen. So underneath revenues, you've got sales or service fees, and you've got other as well. This template can be modified to suit specific business types. So service fees is only going to apply to service businesses because they're generating that revenue from the services that they provide. And then sales will only apply to trading businesses. However, you do have overlap here when it comes to businesses that both offer services and sell goods. So both classifications would be necessary in that case. So for example, think about hairdressers. Oftentimes when you go to a hairdresser, not only do they provide the service of cutting your hair, but they also have different products that they may sell behind the counter, like hairbrushes and different hair products too. So some additional classifications that could be used by businesses include miscellaneous items, dispensing fees, and commission revenue as well. So for example, with commission revenue, if it is a real estate business and the organization has some kind of revenue system where you receive a commission for certain sales of something. And also further subdivision can occur within the categories as well. So sales could be subdivided according to the source of the sales. And that would probably occur in, like I said earlier, a bigger business where you need to organize things out more. In terms of expenses, a standard classification is here as well. You've got selling expenses, administrative, and finance. So again, this template can also be adapted to suit different businesses. So an additional classification for cost of sales would be necessary for a trading business because it would cost the business money to get the inventories in order to then sell them. Usually a service business is not going to have that category. However, it could have another category for the cost of the services. So maybe it has costs that it incurs in order to deliver those services. And some other possible categories, you could have occupancy expenses or promotion expenses as well. And so here is a bit of an outline of those three key kind of categories that you'll need to know for accounting at the year 12 level. So in terms of selling expenses, it's anything associated with promotion, selling, and distribution. So advertising, sales salaries, sales commissions, delivery vehicle expenses and depreciation on a delivery vehicle, for example, because that is distribution related. Administrative expenses is about operating the office and other sort of general expenses that go into a business functioning. So office wages, telephone, insurance, rates, those sorts of things. And finance expenses are associated with funding the business's activities or collecting cash. So you've got interests on loans, you've got bank charges, bad debts, and credit card charges. So if we then look at these next to each other with the service industries and the trading industries, so you can see the service has service in the revenue section, whereas the trading has the sales. And then the expenses section is the same, except you've got cost of sales for a trading business. So if we see this in practice, then we can have a look at this statement of profit or loss and what it looks like. So for example, in the expenses section, you've got selling expenses to start with. We've got advertising, delivery vehicle, sales commission, and sales salaries. We've got administrative expenses with electricity, insurance, office salaries, and then finance expenses, we've got some bank charges, interest expense, and credit card fees. So you can see how it makes it a lot easier instead of having this huge long list that is hard to absorb and hard to understand. Dividing it up to make it a bit neater is what this classification system provides in the way of benefits. Now let's have a look at the statement of financial position. So this classifies assets and liabilities. Now current assets are retained for less than 1 year, and non-current assets are retained for more than 1 year. And these are usually separated when it comes to classifying in our financial position statement. So some examples of primary current assets are cash, accounts receivable, inventories, and then our balance day adjustments with prepaid expenses and accrued revenues. You can see our common classification here, current assets and non-current assets. You can also have additional subdivisions within non-current assets because there's lots of different types. So other financial assets, property, plant and equipment, intangibles as well. So let's have a look at those three categories. We have other financial assets, which are items expected to be retained for more than 1 year to generate revenue. So bonds, shares, anything that is another investment that's going to generate revenue, hopefully. Property, plant, and equipment. So this is about those physical things that you have. So furniture, vehicles, land, buildings. Intangible assets are then the opposite. So they're not tangible. You can't touch them. So you have things like copyright, goodwill, patents, franchises, those sorts of things that can't be touched but still have that monetary kind of value. So like assets, liabilities are classified based on time. So again, current liabilities, they're paid within 1 year. Non-current liabilities are debts that are going to last for more than 1 year, and they are separated from one another. So some common current liabilities, there's more of these than there are non-current. So bank overdraft, where you are in debt, you don't have any cash at bank, you've got an overdraft where you owe the bank money. Accounts payable, GST clearing, short-term loans, and then our balance day adjustments of accrued expenses and unearned revenues. And then non-current liabilities are basically those longer-term loans that you may have. Now, owner's equity is the other section that we find in our statement of financial position, and it's typically displayed in more detail than strictly necessary to illustrate how the capital account has changed during the accounting year. So instead of simply listing that final balance for the capital account, it has the opening balance at the start. You then have the profits generated during the year that are added. Then you subtract losses or drawings, and then you list that final result to show that whole process. And you'll see here in this example, which we'll look at shortly, that we've got 180,000. That was our opening balance. We've added that net profit, and then we've found the result of that. So 224,000 is what we've got by adding that, and then we subtract the drawings in this case, and we get that final figure. So this statement can be formatted in different ways, and that is going to impact the classifications that are used. And so the statement of financial position can be in narrative form without working capital, narrative form with working capital, and in account form as well. So let's go through each of these as well. It's important that you are aware of these different types because you may be asked in your assessment pieces to take on different forms. It's always handy as well if you're able to do it yourself, and that will then help you to be analyzing, even if it's given to you as a stimulus piece. If you're familiar with the layout and how it all works, that's going to help you analyze it too. So first of all, narrative form without working capital. So when we think of this narrative form, it's, I suppose it's longer. You're displaying it all out in more of a fashion that it's only sort of one column going down. We'll see the comparison to the account form shortly, where it's more horizontally based. So without working capital involves having all of your assets listed first, current assets, and then non-current assets. And then liabilities are separate with current and then non-current before you have the owner's equity at the end. On the other hand, when you do have working capital, you start off with current assets, which is the same, but then you go straight to subtracting current liabilities. So instead of having all of the assets to begin with and then the liabilities, you're focusing on what is current and then what is non-current. So once you've got the that subtracted figure, so current assets less current liabilities, you can see at the top of that second screenshot on the right, you've got the working capital figure. And then you continue on with those non-current assets and liabilities, and the owner's equity section remains the same. And account form, you can see more of a horizontal structure in that you've got the things next to each other. So current assets here is on the left and current liabilities on the right, with the owner's equity at the bottom there. And you've got your figures that are matching up on each side, you can see those total values at the bottom.